History doesn't repeat itself, but it often rhymes. When you compare this market to the last impeachment go-around with President Clinton, it's really pretty astonishing how much of what was working then is also working now. Back in the 90s, the late, great Mark Haynes, just an amazing host for CNBC, used to call me Reverend Jim Bob from the Church of What's Happening Now. I love the name. But what was working in 1999 turned out to work for a lot longer than anyone expected, even if the dot-com crash temporarily erased some of those gains. Clinton was acquitted in February of 1999, so let's peruse the best performers from the major averages to see if they can give us any insight into how to handle the Trump impeachment proceedings. The best performer in the Dow Jones average from 1999 wasn't in the index back then, but it sure is now. Care to guess? Whoa, I think I replaced my apple with my peach. But here it is. Apple, up 100. Wow, someone gave me a new shiny one. Up 151% for the year of the last Senate trial of a sitting president. Isn't that incredible? This was the beginning of a much larger run led by Steve Jobs after his triumphant return in 97. You know what worked back then? And it works now. Yeah. Own Apple. Don't trade it, please. Second best performer, Cisco. Right at that moment in 1999, Cisco was at the center of the internet boom. They were considered to be the backbone of the entire build-out. But Cisco flew way too close to the sun back then, rallying 130% in 1999, and then soon fell back to earth, plummeting to the single digits as its telco clients went belly up. 1999, I mean, it just kept going and going and going. Even today, the stock still hasn't fully recovered. The amazing thing is that Cisco survived, frankly, at all. Now I think you're getting one of the best buying opportunities in ages because CEO Chuck Robbins, and we like to get all these numbers right, CEO Chuck Robbins, he, well, incredibly reinvents the company, making Cisco more of a subscription software Internet of Things play with a fantastic 5G portfolio. But that's for the enterprise, okay? It's not right now. All right, it's going to be back of the end of next year. Now, back in 1999, interest rates were much higher. Not now, though, which is why Cisco's 3% yield here is so enticing to me. Their best performer was Walmart. This stock's been on fire for ages. It really hasn't quit. The fact that it was only up 70% in 1999 gave you a terrific entry point. I remember many people saying that Walmart was horrendously overvalued back then versus the fancy pants retailers where most of these rich analysts shop. But I'll take Walmart's 20 to 120 run since then any day of the week. Or any day in the last 20 years. You know how Facebook and Alphabet are facing all sorts of government investigations right now? Well, back then we had another software colossus in the midst of the mother of all federal investigations. United States versus Microsoft. An antitrust horror show that many thought would crush the company, although it still managed to rally 68% in 1999. Remember, everything was going nuts at that period. The antitrust case turned out to be a buying opportunity, but only long-term, as Microsoft swiftly fell from 50 to 13 when the dot-com bubble burst. I still like Microsoft up here in the 150s. Satya Nadella doing such a remarkable job. The regulators, they no longer have these guys in the crosshairs. Fifth is Home Depot, also rallied 68% that year. Well, that was on the way to national domination. While its business never really faltered, the ensuing recession caused the stock to get slammed. It took more than a decade to recover. You know what? I still think that Despot's cheap at 218, roughly 20 points off its high. 2.5% yield. Now, the company just stumbled because of lowered guidance, but I predict that will be a blip over the long haul, even as I was quite upset about it, to tell you the truth. Sometimes you get these moments where tech shines so brightly that it dominates not just the NASDAQ 100, but also the S&P 500. And the period after the Clinton impeachment was one of those. The leader, Qualcomm, which rallied an astonishing, I know you won't believe this, but yeah, you had to live through it, as I did. It was up 2,619% in 1999. That's what a 3 to 88 run looks like. Talk about Icarus. This darn semiconductor stock fell to 7 not long after that. It took about 20 years to get back to that lofty and definitive top. Qualcomm has always been a creature of improving cell phone technology, and now it's 5G that beckons. With the stock selling for 14 times earnings, sporting an almost 3% yield, this makes no sense to me. I think the stock should be much higher, especially after that terrific quarter that Moo, which of course is Micron, just reported this evening. S&P's second best performer in 1999 was VeriSign, up 1,192%, which made perfect sense because it's a domain registration company, and there was a domain name gold rush back then. Guess what? There still is one now. And VeriSign's got all sorts of ancillary businesses. They reinvented themselves. Terrific returns. Stock peaked at close to 260 in 2000 and crashed to the single digits during the collapse. But like Cisco, it stayed in business, even if it took the stock 20 years to fully recover to those levels. Let me give you another one. Third best performer in the S&P in 1999. Lam Research, LRCX, up more than 500%. I liked the semiconductor capital equipment maker back when I was a hedge fund manager, and I like it again now, even as it's up more than 100% for 2019. One of the best performers in the S&P. What's the secret sauce here? Lam dominates this industry along with Applied Materials, which is one reason it never really got crushed during the dot-com collapse. I think it's actually got more room to run here, even as it's only a few points from the high. But this one, I mean, how can you not wait for at least a tad of a pullback? The rest of the winners from 1999 that are still kicking, they remain intriguing here, but not as viable. NASDAQ 100 is number 4. Checkpoint Software, a version of cybersecurity that I'm just okay with. Number 5, Biogen. You're taking a flyer there on Alzheimer's treatment with that one. I prefer other drug stocks because of the binary nature of that company's prospects. Oh, and let's end with a curious oddity. This morning, my colleague David Faber talked extensively about how Dish Network's Charlie Ergen is trying to buy some assets that need to be divested before Sprint and T-Mobile can get federal regulatory approval to merge. Dish wants to build out a national 5G network, which could cost billions and billions of dollars. Ergen testified yesterday that he has $10 billion in financing lined up to make it happen. Back in 1999, Dish was a great growth company. Its stock was up 706%. But like so many others in the telco and transmission space, its stock crashed back to earth in 2000. It took 14 years to rebound to its old highs. Me, I'd rather own AT&T with more than 5% yield, or T-Mobile, which will have good growth even if the Sprint deal gets blocked by various states' attorney general who definitely want it spiked. You know what my takeaway is? We keep thinking about how hard it is to own tech, all of us, you, me. You know, it is hard. Many of those winners from 1999 collapsed soon after the post-impeachment rally. But the bottom line, for the companies that survived, in most cases, the dot-com crash, it proved to be an excellent buying opportunity. Oh, boy, did you need to be patient with some. Not all. And impeachment or no impeachment, I think that lesson still holds true today. Let's take calls. Let's go to Bill in New York. Bill.
Hey, Jim. Thank you so much for taking my call.
Of course.
I've been watching your show for about 10 years. When I first started investing when I was 22, think you're a huge help with everything you and your team do on your show.
Oh, man, you're a champ. Thank you. Long day. Really appreciate it. What's up?
Absolutely. So I bought United Rentals about a year and a half at what I thought was a pullback from its highs. Unfortunately, the stock continued to trade down. It's been on a big run for the last 3 months, but I'm curious if you think it's going to go a little bit higher or if this is my time to get out and put my money somewhere else.
I am bullish in the U.S. economy ever since the Fed cut rates. URI is a definitive play on the U.S. economy. Does have some oil exposure, which I'm not crazy about. I think you're fine. But I would take some off the table. You just had a gigantic run. And I know that bulls make money, bears make money. Alex in New Jersey. Alex.
Hey, how's it going, Jim?
Not bad, Alex. How about you?
I'm doing good. Thank you for asking. I want to get your opinion on something if you got a minute.
Sure.
So the stock, its earnings are coming out tomorrow, right? And with two failed mergers, stores closing, and Amazon getting into the space now, the pharmaceutical space, is Rite Aid worth looking at, or
No.
would you recommend something like CVS or Walgreens?
No. I don't know. Maybe I'm not being definitive enough. How about absolutely no? How about no chance no? Don't buy. Sometimes it just happens. CVS is much better. Do not buy Walgreens. Walgreens doesn't really have it together. My Chapel Trust on CVS, you can read all about it because we at AcceleratePlus.com. Stuck at 73 right now. It's going to earn $7 next year. Give it a 10, give it an 8 multiple. I think that's really reasonable. You still got another 12, 13 points to go. So let's buy CVS. Hey, by the way, I'm going to throw in CBS. Viacom CBS. That's a twofer. All right, let's go to Steve. Oh, in Dallas Goddard country. By the way, Dak Prescott. maybe not. Steve in South Dakota. Steve.
Yes, you're right. You guys got a great tight end from here. So with Pfizer, Barron's just posted something a few days ago. They were talking about their top 10 stocks for 2020, and they named Pfizer as one of them. They also just increased their dividend a few days ago. I think they're yielding about a 3.8 now. My only concern with Pfizer is you've seen some other big pharmas like Bristol Myers Squibb, Lilly. Their stocks appreciated quite a bit lately, whereas Pfizer's just kind of been stuck in the sand. What do you think on Pfizer going forward?
Look, that's Pfizer. That is what Pfizer is, Steve. It is slow, it's steady, but it does win some races, not all. I'm okay with Pfizer because of the yield. I'm okay with Pfizer. Not crazy about it, but okay with it. I like others more. I'm going to Mike in Oregon. Mike.
Hey, Jim Cramer, booyah. From
Booyah.
Oregon, go Ducks.
I like the Ducks here. What's up?
Oh, hey, I've got a concern about Lockheed Martin.
Why?
Hey, I've been, I've worked for Lockheed for 34 years. Been buying it since I was 25, loaded up my ESOP, and consistently it keeps overwhelming my portfolio. And now I'm 66 and retired. And again, it is overwhelming my portfolio. And my money manager is saying, what do you want to do? I'm at 42%. And I'm debating whether I should trim back.
I got to tell you, Mike, when you told me that number, I'm going to have to side with your money manager. Well, it's not really side. I work closely with everybody. That is a little too much, particularly at your age, which, by the way, I regard as very young and think you should come out of retirement so I don't feel so bad. But I do think that Lockheed Martin is a very good stock. You worked at a great company. Congratulations. But you own too much of it versus the rest of your portfolio. Fact of life. All right, history often rhymes. Stay patient. Now, much more Mad Money Head, including an update on where we are in this impeachment process with CNBC's own Eamon Javers. Now, Eamon may not understand the concept of the eat a peach, but you know what? I'm a big Allman Brothers fan from way back. Then that wasn't the only story that dominated the market today. I'm breaking down FedEx's latest earnings, telling you where to go from here, and all your calls rapid fire in tonight's edition of The Lightning Round. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.